This idea of using gold and stable coin to kind of reshuffle the deck chairs on the Titanic debase the dollar. Significantly, then bring it with the gold valuation. Because we've seen from Besant in the Fed papers that came out in August and July, they're slow dripping us, getting us ready for the possibility. You're watching Silver News Daily, subscribe for more. The world is standing on the edge of a financial event. So massive, it could reset everything. We know about money. Behind closed doors, the Federal Reserve is panicking. And now, for the first time in over 50 years, serious discussions are emerging at the highest levels about a full-scale dollar reset. But this time, the plan is more dangerous than anything we've seen before. A hidden strategy involving gold revaluation and stable coins is quietly being put into place. And if it goes through, it won't just impact the rich. It could wipe out the life savings of millions of ordinary people overnight. But here's where it gets explosive. While the mainstream media fixates on stock markets and election drama, something much bigger is happening beneath the surface. Gold is rising. Although the dollar's devaluation would be shocking, silver is quietly positioning itself to be the biggest winner of this entire financial upheaval. This isn't due to hype, but rather to the fact that all the math, history, and market signals point to an impending surge that could send silver to levels no one is prepared for. Is it possible that gold might be revalued at $10,000 or even $20,000, $50,000 per ounce? What does this imply for the current price of silver, which is far lower? This is more than just a shocking answer. I always wonder, how relevant is this? But if you stick around until the end, you'll see how the Fed's next move could set off a silver supernova that reimagines wealth in the modern era. T-bills are the best market collateral, so anything could happen. Both the markets and politics are affected by it. Personally, I'm not too concerned about the 25 bip movement right now. What matters is the direction of the trend, and Powell's future plans involve more cuts. What's interesting is what he did after the cuts, though, because the cuts themselves were predictable, as I mentioned before. In his press conference, he essentially stated that the labor markets are wonderful and that labor resiliency was the key. However, with this BLS downward revision, he now thinks it was a mistake. My reaction, like many others, is to wonder what he means when he says that there are 925,000 labor revisions, and that it's the biggest ever. He also implies that we kind of expected this. You must have been lying last year if you said you weren't guessing, because the Fed is completely reliant on statistics. Again, if you don't trust your data, there's no need in having it and relying on it for anything. He went so far as to claim that they don't truly know what the future holds when it comes to predictions. What good is your prediction if we don't have any idea and you're not even claiming to believe your data? Was there anything else you brought up that he jabbed at? Powell and Trump are embroiled in a kind of Cold War. Trump has insulted Powell by calling him a loser and a moron in tweets. Classic Trump speech, loved by some and hated by others for its bluntness. But Powell has his own way of essentially stating that tariffs are contributing to price inflation and that American importers are bearing the brunt of these higher tariffs and costs. This is Powell's way of poking fun at Trump, since if American importers and tariff-sucking companies are going to raise prices, then Trump is right. They're likely going to lay off workers because that's inflationary. That's employment-related. So Powell's basically blaming some of the employment and some of the inflation on Trump, which fine. We can argue about tariffs all day long, and we've done it many times. But what's really disingenuous about that, and I think in Powell's mind, very disingenuous to me, is he's ignoring decades of monetary and fiscal drunk driving by the Fed, by Congress, and by other White Houses before Trump, Bernanke, expanded the balance sheet by 2.5 trillion in 5 years, and Powell did 5 trillion in 18 months. So if you're going to talk about inflation, you want to pick on Trump's tariffs. There's room for that, academically, intellectually. But come on, Powell, you're part of this Fed. You're part of this great beast, this creature from Jack-o'-lantern. You are part of the problem for inflation that goes back decades. So I thought that if gold is the anchor of a collapsing monetary system, then silver is the fuse waiting to ignite, and in any serious gold revaluation, silver doesn't just tag along, it explodes. Let's break this down right now. The current gold to silver ratio is about 88 to 1. This indicates that for every ounce of gold, there are 88 ounces of silver that are worth the same. Clearly, this ratio has been drastically off throughout the past century. The average ratio has hovered closer to my 47 to 1. Go back further, and you'll find eras where it traded near 15 to 1 and even 12 to 1 in ancient times. So if gold suddenly revalues, say, to $10,000 an ounce, that same 88 to 1 ratio would suggest silver shoots to $113 per ounce. But here's the twist. Revaluations always come with ratio corrections in every major monetary reset. In modern history, the gold-silver ratio collapses. And when it does, silver outperforms gold massively. Why? Because silver has something gold. Doesn't accessibility a middle-class family might never afford an ounce of gold at $10,000. But silver, that's where they'll go. It becomes the poor man's gold. And in times of monetary chaos, demand doesn't just rise, it detonates. What we're looking at isn't some fringe theory. As a result of central banks buying gold at record rates, suggesting a change in monetary backing, silver's price remains artificially low. This disparity cannot continue if gold doubles, triples, or even quintuples as part of a financial reset. Silver's price could jump tenfold or more, hitting $100, $150, or even $200 per ounce. The ratio would demand it, and it's not a fantasy. There's a lot to draw from and themes to begin with, but it's the most recent news, so it's just history doing what it always does. It's important to discuss these rate cuts since they were highly anticipated. In fact, the whole market and world anticipated them. The Federal Reserve lowered its benchmark interest rate to 4.25% or 4.50%, as most listeners are likely aware. Over 95% of market participants anticipated this move. Can you explain it? Which things were admitted? What is the truth underneath this? Some of Powell's comments in the Q&A after the cut were particularly illuminating. For example, he used terms like trajectory that the Fed is on, which, in my opinion, basically means a lot of different signals, but what the Fed says and does are very different from what's really happening. Additional layoffs may be on the horizon. So, he's preparing for this by saying things like, if we don't cut rates again in 2 or 3 times this year, the markets will react negatively to a rate hike. This is an intriguing hint from the Q&A, but it seems like Powell is trying to stimulate the economy by saying things like, basis at the 25 basis points won't do it to make the stimulus. Those are just some of the first impressions I got from listening to Powell and other Fed speakers, such as Bernanke, Greenspan, or Yellen, speak. The markets and their reactions are so predictable right now. Interest rates go up or down depending on whether inflation or unemployment is a bigger threat. So, rates tend to go up when inflation worries are high and down when employment worries are low. As many may or may not be aware, the Bureau of Labor Statistics recently released the most dismal report on non-farm payroll jobs ever. A total of 925,000 jobs were cut. I mean, That's even worse than what we saw in 2009 after the great financial crisis. So clearly, Powell was thinking about unemployment when he justified a dovish lower rate policy in response to the labor crisis. Unfortunately, that's exactly what happened. The reality is that the Fed's real mandate is a sovereign bond market, not necessarily employment or fighting inflation. The real question is whether cuts even matter at the moment. In many ways, the Fed is a lame duck, regardless of whether it raises rates or not. As of right now, the short-term T-bill market rate is lower than the Fed funds rate. The US, the national debt has risen to over $37 trillion, and the government's last resort, which no one dares to mention, is to inflate the debt away. This means that the value of the dollar will decline. The Federal Reserve is deliberately enacting a policy of controlled currency destruction, which is what economists call a constructive default. Instead of missing payments, you will repay the debt with dollars that are significantly less valuable. Here's where silver comes in, not as a speculation, but as a lifeline. The truth is that every rate cut, stimulus program, and new treasury auction brings us one step closer to the point where confidence in the dollar begins to erode. When that happens, capital won't sit idle. It will flee the fiat currency. Since silver, in contrast to gold, is a functioning metal, it does more than simply sit in vaults. It exposes monetary debasement. It gets consumed, demanded, and depleted. This is why the Fed's desperation is so bullish for silver. When they slash rates and pump liquidity, they're not stimulating growth. They're destroying real yields and lighting a fire under tangible assets. Today, the real yield on 10-year treasuries is negative when adjusted for actual inflation. That means savers are guaranteed to lose money. Meanwhile, silver, scarce, indestructible, and universally recognized, is becoming one of the only hedges left that hasn't already been priced for panic. And when this reset accelerates, the window to act will slam shut, because as the dollar burns and gold gets revalued to absorb global debt, silver won't wait. Politely, it will do what it always does. It will slingshot into motion, turning from ignored to indispensable, almost overnight. I think it was dishonest. And this dishonesty is again one of the symptoms of a debt-sick nation. We've seen other forms of dishonesty since then. The modern monetary theory, this idea, you can print money, unlimited money, and not have inflation. And we can go into that for hours. But that's clearly a fantasy. That's a lie. The idea that inflation is temporary or transitory, that we can control it like a thermostat that's been alive for the last 50 years. Recently, in 2022, when we were in a recession. In my opinion, we are still in a recession that we changed the rule of what a recession is. That was a lie for the last 25 years. The RIA industrial complex and private wealth managers from every major bank have been telling investors that gold is too volatile. That was a lie, was a deliberate lie. Gold's outperformed the S&P in the last 25 years. So one of the big consequences, not just currency debasement, is dishonesty. And I think the third consequence is really desperation. And we see that in the headlines all over the place right now. The idea, and again, you could pick any one of these threads later, Elijah. But the obvious signs of desperation is that tariffs are going to save us, or that stablecoin is going to save us, or that cutting spending at Doge or USAID is going to save us, or even more.